Hey, good afternoon, everyone. This is Trader Tim from eminimind.com doing another Monday market analysis video. I know it's been a little bit quiet these last couple of weeks. Been pretty busy outside of the morning, my own morning trading. I haven't had quite as much time to record some videos, but we're back and wanted to run through the E-mini S&P today and talk about a whole host of things related to both day trading and swing trading. So let's dive right in. The first thing you'll notice on the daily chart, and we can even go over to the SPY just so we can see the volume a little bit easier. Big surge in volume on this sell-off. We've bounced to the halfway back short, and then today we tagged the halfway back long. Now both the short and the long are drawn using the trading hours only. Um, at this point, if we break the 61.8 of the long, then we should see a completion of the short. And if the next couple of days we hold at the long and come up and break the 61.8 of the short, then we should complete the long and then go into new highs from there. It feels like completing the short is the one that will sort of come to fruition, but we'll wait and see. If we look at the extended hours on the ES, um, we can pull, the low to high and see that we haven't quite made it to its 50%. Now I prefer to use just the trading hours only because that's where most of the trading takes place. There's a lot more volume when the market's open. And so it gives us a really nice clean line in the sand. We've got a long 28.66 and a 61.8 failure, and then the short failure is 29.50. So pretty clear where each of those might end up. And then if we move lower, break the 61.8, now we've got a 27.71 target, and that puts us right down around that kind of 10% correction area, sort of down at the larger halfway back. It's 50% that hasn't quite tagged its negative 23. We got close, maybe 30-ish points away, but 20 points away, but didn't make it up and touch that 30 60s exactly. So that's what we've got going on from the bigger perspective. In terms, before we go and talk about some of today's trades, in well, before we even get to the interest rate discussion, the if you notice, we've been completing a lot of unfilled gaps. So some of the gaps that were in place back here had been completed and almost reversing right at those levels. So pay attention to, you know, as we continue in this higher volatility, pay attention to where the gaps are and, write them down or record them on the market profile if you do chart that. And those are areas that are going to be retested. And it's pretty easy when we come into a gap, like over here, we had the gap all the way up here. That was the close. And then once we moved up into this area where price had not traded in the prior couple days, boom, it's an instant, well, not instant, but it's a very quick trend day that takes back that gap. So you can really capitalize on an intraday perspective when you know where those gaps are. Last Tuesday in the trading room, I was talking a little bit about the bonds and the stock market and the interest rate. And I just wanted to kind of clarify some of the relationships that we were talking about. We had a couple of good questions on this. And so when you have a low interest rate, like the Fed funds rate, you end up sort of with this inverse proportion where uh, low interest rates lead to higher bond prices. And we've been seeing a big run up if you look at any of the bond funds. One that I've used over the years in the Vanguard funds, the VWESX, kind of the long-term investment bond. At the start of the year, if I go back to the weekly chart, uh, we had a little bit higher interest rates. It's still pretty low, but as we were coming down towards the end of last year, it was really starting to look like the broader market was gonna um, kind of get some lift. At least that's what a lot of the talk and the expectations and promises were kind of coming from the uh, the White House and the administration and that sort of stuff, doing things to pump up the economy. And so at the beginning of the year, I kind of doubled down on the stock market, if you will, and put some cash into some longer term investments in addition to swing trades that ended up lasting a couple of months as opposed to just a couple of weeks. And so you've got a strong stock market, but then at the same time, you had interest rates being, in the last Fed meeting, they lowered interest rates. And so if you think back to like 2005, 2006, you could open up a savings account with uh, 5% interest rate, 4% interest rate, which is pretty high on today's standards, whereas savings accounts are around 1.5%, 2%, and even that's on the higher side. So as we see sort of the decline in interest rates, the rise in bonds, and the rise in the stock market, it doesn't really give us much wiggle room if the market were to pull back and go down. Well, in order to sort of ease and help the markets along, you can only lower the interest rates to zero, and they're not far off of that in a relative perspective. So, interest rates and bonds are an inverse relationship. When one is up, the other is down, and vice versa. And so now we have the situation where interest rates are pretty low. It's pretty cheap to borrow money. Home prices have definitely come up quite a bit from obviously the 2008 crash, but uh, you can still find some reasonable home prices, but they're certainly pretty high. Yet borrowing money is cheap. So just some things to consider as we look at the stock market. A lot of the times we're not thinking about how the stock market in its relationship to the economy, the real estate market, the bond market, the interest rates, and things like that. But as you're, day trading or swing trading, it is helpful to pay attention to, what the bonds are doing and some of these other markets and see how they're correlated and how they relate to one another. So even if we sell off here and move down to like the halfway back, there's still a lot of room and possibility for us to move higher. So don't be surprised if we get some serious down days in the next week or two. And don't be caught off guard if we get some gap ups and then serious, big up days, because we tend to get very big up days in the context of a downtrend. As we switch gears to more intraday, I don't find myself changing much in terms of, I don't really change my strategy when volatility is higher or lower for that matter. So this morning we started off uh, okay in the first 10 minutes, sort of downtrending, but then we went into this kind of wild, almost retesting the very first halfway back. So I left that up because we hadn't hit the negative 23% target all the way until like 40 minutes into the day. And so once we sold off, we hit the 50%, sold off again, moved a little bit lower, and then came right back up to the 50%. We had a low tick down here near the 25-minute mark, and we made a little bit of a double bottom, and that was where we were pretty close to the negative 23% target. So being at the the bottom of the first 30-minute range, the negative 23% target, that's set up in the long at the 96 96 and a quarter, but it did come down and then get a little bit of heat, traded down to 94.75 and stopped me out there. And unfortunately, reversed, went a couple of points up, and then retouched that halfway back yet again. So that was my first trade. Um, as we came down, we didn't really break through the 61.8. And so seeing that, that first trade got me some momentum, even though I got stopped out. It had momentum and rallied for, 3 or 4 points. When we came down again to the negative 23% target, bottom of the first 30-minute range, I was looking at, okay, how can I, get in long down here? And I drew up, since the negative 23% target was right down here, I drew up the next retracement, and unfortunately we stopped right at it. And so taking the first long was much higher risk because this short had traded first. So instead what I did was just wait for this 61.8 to fail, and then I just took what essentially is the second retracement in the trend. And so, using the first trade, even though it, stopped me out before it got going, seeing that it did get going and seeing that the long um, got some quick momentum, that gave me the confidence to, not necessarily jump back in immediately, but when that similar setup took place a little bit later, start looking for longs, and then seeing that the first one stopped right at the halfway back short. Following the same process of whichever one trades first is the one you have to go with. In this case, since I was looking for a long, I just passed on the short, and then when the 61.8 failed, I just drew up the next long, and then that one ended up being a pretty sizable winner, moving from the bottom of the first 30-minute range to just a little bit higher than the top of the first 30-minute range, but with a uh, bigger range, more volatility. I'm using the same point and a half stop. I'm using the same retracements and all that stuff, and you end up with, a quick move. This is quarter after to like 25 after. So you're only like 10, 15 minutes, and it moved 10 points. And just a matter of, drawing up the next retracement, trying to find the next swing low, and then the next swing low, and the next swing low. And then once we started to go uh, really quickly up here, I just zoomed in and then started trailing each candle's low, and then ended up getting taken out at the top of the first 30-minute range. So, you don't have to make huge adjustments just because volatility is higher. And, if you take a stop out, you want to make sure that you're set up in a way where, one winning trade is going to cover, in some cases, 3 or 4 losing trades. Now, obviously, not every trade is going to be a big runner like this, but, this isn't out of the ordinary, this kind of a move. In lower volatility situations, this might only be, a 5-point move, but it's still a pretty solid move. So just because you get stopped out in the trade doesn't mean you need to jump back in immediately, but use the context of what's happening at the start of the day, what setups are working and what setups are not, which direction is working, which direction is not, so that you can take that information and move forward to be able to uh, make good trading decisions based on like what's happening and the patterns that are occurring throughout the day. So those are the only two that I had this morning, and the rest of the week will kind of be determined by which 6018 we break, the short or the long. So you can tune in to the live trading room that I was talking about over at eminimine.com/VIP. We'll be doing that on Tuesday mornings, so tomorrow morning. And if you have questions, feel free to chime in below and put them in the comments box, and happy to answer any of those questions you have. So thanks for tuning in, and have a great week of trading.